Hello students, in present video I am going to explain about fifth problem from partnership accounts topic. So previous videos links are given in the description box. I am taking this question from Telangana State Telugu Academy Inter Second Year Accountancy Textbook. But this video is useful to all commerce students who want to know about this topic. Let us see the question first. Ramu and Robert are partners sharing profits and losses in the ratio of 5:3. Give journal entries for the following and give capital accounts of Ramu and Robert. He is asking two questions here. First, journal entries, then Ramu and Robert capital accounts. And 5 points are given. So for each point, journal entry we have to write. Then based on these journal entries, capital accounts we should prepare. First, journal. Journal format is date. But here dates are not available now. Instead of date, serial number, particulars, LF number, ledger folio number, debit, credit. Okay. So first A is capital introduced by Ramu 50,000 and Robert 80,000. So this is firm. Ramu and Robert are partners. They introduced capital into the firm. So from them, cash is coming. To write the journal entries, first step is in present transaction, how many accounts are there we should identify. So in firm's books we are preparing journal. So think from firm's point of view. Cash is coming from partners. So first account is cash account. From whom this cash is coming? From partners. Ramu, Robert. Ramu account, Robert account. So total 3 accounts are there. Second step is accounts are of 3 types now. Personal accounts, real accounts, nominal accounts. We have to identify cash account is a personal or real or nominal. So cash means asset. With asset name, if you open any account, that is real account. So cash account is a real account. Ramu, Robert. Person names. With the person names, if you open any account, that is personal account. So these two are personal accounts. Finally, apply the double entry rules. For real account rule is debit what comes in, credit what goes out. Here real account is cash. If cash is coming into the firm, cash account we should debit. If cash is going from the firm, we should credit. Here cash is coming from partners now. Therefore, debit what comes in is applicable. Debit cash account. Both are personal accounts. Personal account rule, debit the receiver, credit the giver. If partners are receivers, we have to debit them. If partners are givers, we have to credit. Here, partners are giving cash to the firm. They are givers, so we should credit. Finally, cash account we should debit. Ramu and Robert capital accounts we have to credit. So first entry is cash account debtor to Ramu capital account. Instead of writing only Ramu word, add a capital word also. To Robert capital account. Ramu is bringing capital introduced by Ramu 50,000 now. So Ramu account is credited. So in credit column 50,000 rupees. Robert brought 80,000 rupees capital. For Robert in credit column 80,000 rupees. In debit column for cash, total we should write 1,30,000 rupees. Narration I am not writing because place is not permitting me. So capital accounts also we have to prepare now. Narration is being partners introduced capital into the firm. Come to second one. Drawings by Ramu 5,000 rupees and Robert 6,000 rupees. This is firm. Ramu, Robert. These two partners withdrew some amount from the firm for their personal use. So from the firm, cash is going. Accounts we should identify. Ramu and Robert are withdrawing now. So Ramu account, Robert account. These two accounts are there. From the firm cash is going, therefore cash account. Total 3 accounts are there. Ramu account, Robert account. Both are personal accounts, no? Cash account is a real account. Personal account rule. Debit the receiver, credit the giver. See, Ramu and Robert are taking money from the firm. They are receivers. We have to debit them. Real account rule. Debit what comes in, credit what goes out. Think from firm's point of view. From the firm cash is going, credit what goes out is applicable. We should credit cash account. So instead of writing Ramu word, write down Ramu's drawings. Similarly, Robert drawings. Because in inter first year also you learn, when owners withdraw some amount from the firm for personal use, drawings account is to be debited, no? Instead of owner's name. So Ramu drawings account data. In BB, 2 entries will be there. Therefore, in B, first entry is Ramu drawings account data. See the BB, drawings by Ramu 5000. His account is debited, no? So in debit column 5000. Next, Robert drawings account data. Robert withdrew 6000 rupees. In debit column 6000. 2. From the firm cash is going, no? So cash account we should credit. In credit column total 11,000 rupees. This is first entry. Now come to second entry. Second entry is drawings we opened. Drawings accounts we opened by debiting them. Now drawings we should transfer to capital accounts, no? Recollect intern first year final accounts. So in final accounts, balance sheet liability side, from capital we used to deduct drawings, no? Here also same. So to deduct drawings from capital, we should write one journal entry. That is, drawings accounts we should close by transferring their balances to capital accounts. So to close the drawings accounts, in other words, to transfer drawings account amounts to capital accounts, we have to write one entry now. B-bit second entry. How we create a drawings account? By debiting. If you want to close drawings account, then you have to credit them. So, to Ramu drawings account amount 5000. 2 no, means we are crediting, no? So in credit column write down the amount. Then 2 Robert drawings account amount 6000. Ramu's drawings account, how we should close? By transferring the balance to Ramu's capital. Therefore, Ramu capital we should debit. Amount 5000 in debit column. Robert drawings account, how we should close? By transferring this 6000 to Robert capital account. Therefore, debit Robert capital account 6000 rupees. This is the final entry. So for B1, what is the narration? Being the entry for partners drawings. For B2 entry, narration is being the entry to transfer drawings account balances to capital accounts. So still you may have one doubt, that is why capital accounts are debited. So why drawings are credited? Here clear, because in second entry we created drawings accounts by debiting them. If you want to close them, then you have to credit them. But why capital accounts we are debiting? Further, you should know one point, that is capital is a liability. Liability shows a credit balance. Capital always shows a credit balance. Therefore, if you want to increase the capital, you have to credit capital accounts. If you want to decrease capital, you have to debit capital accounts. Suppose, see the first A entry. Partners brought capitals into the business. So these amounts we should add to their capitals, no? Means because of this transaction, partners' capital balances are increasing. So increase means we should credit capital accounts. That is why we created these two capital accounts. Come to this entry. Drawings amount 5,000. We should deduct from Ramu's capital 50,000. So 50,000 minus 5,000 becomes 45,000 now. So when you transfer drawings to capital accounts, then Ramu capital and Robert capital both are decreasing now. So capital shows a credit balance. If you want to decrease them, you have to debit them. That is why capital accounts are debited. B bit is completed. Come to C bit. Interest on capital, Ramu 2,500 and Robert 4,000 rupees. So interest on capital. This is firm. Ramu, Robert. They brought capitals, no? In accounts, we follow business entity concept. That concept says that owner is separate, firm is separate. So partners are owners only. So when partners are bringing capital into the firm, we should assume that firm is taking loan from outsiders. Firm is taking the loan. So who should pay interest to whom? Firm should pay interest to partners now. So interest on capital, firm should pay to partners. In firm's books, we are preparing accounts. Think from firm's point of view. Firm is paying interest. Means to the firm, interest on capital is expenditure. No? So one account is interest on capital account. Then interest on capital account is a nominal account. Because to the firm this is expenditure now. With expenditure name, loss name, income or gain names. If you open any account, that is a nominal account. Nominal account rule, debit all expenses and losses, credit all incomes and gains. So this is expenditure, means we should debit. In C bit, two entries come. In first entry, we should debit interest on capital account. Data. 2. Capital, owner's money. Interest on capital also owner's money, because firm has to pay to owners now. Means this interest on capital to capital we should add. No? So because both are owners amounts, if you add, capital increases. So if capital increases, we have to credit capital accounts. Therefore, Ramu capital, Robert capital, we have to credit. 2. Ramu capital account. 2. Robert capital account. Ramu capital. Ramu's interest on capital is 2,500. Ramu capital is credited now in credit column for Ramu's capital 2,500. Robert 4,000. So for Robert capital, write down 4,000. So means what? To Ramu's capital, how much interest we are adding? 2,500. To Robert capital, how much interest we are adding? 4,000. So for interest on capital, these two amounts total we should debit. 6,500. So for interest on capital, this is the first entry. Second entry is what? Interest on capital account is a nominal account. No? Nominal accounts are temporary accounts. So temporary accounts at the year end we have to close. Suppose wages, where we show in final accounts, trading account debit side. Means wages account we should close by transferring the balance to trading account. Suppose salaries, where we show in final accounts, profit and loss account. Means salary account is a nominal account. How we should close at the year end? By transferring to profit and loss account. Similarly, interest on capital is a nominal account and this is partner related expenditure. No? Once you recollect previous problems, partners related incomes, partners related expenses, in which account we should show? Profit and loss appropriation account. So partnership final accounts contains trading account, profit and loss account, profit and loss appropriation account, capital accounts, balance sheet. No. So profit and loss appropriation account. In this account, we have to show partners related expenses and incomes. So this is nominal account, interest on capital account. We should close that account by transferring to profit and loss appropriation account. For that second entry we should write. How we created interest on capital account? By debiting. If you want to close this account, you have to credit to interest on capital account 6,500 credit. To which account we should transfer? Profit and loss appropriation account. Once you recollect previous problems, profit and loss appropriation account is a nominal account. So debit side expenses, losses, credit side incomes and gains we should show. If you want to post interest on capital on the debit side of profit and loss appropriation account, while writing the journal entry, profit and loss appropriation account should be debited, no? So debit that account. Profit and loss appropriation account. Same amount, 6,500. CBT is completed. So what are the narrations for these two entries? First entry being the entry for interest on capital. Second entry being the entry to transfer the balance of interest on capital account to profit and loss appropriation account. Next come to debit. Interest on drawings, Ramu 300 and Robert 400. Debit entries I am writing here. Interest on drawings, Ramu 300 and Robert 400. Recollect inter first year final accounts. Interest on drawings. So from capital, first drawings we should subtract, then interest on drawings we should subtract. Means interest on drawings from capital we have to subtract. So interest on drawings, who should pay to whom? Let us see that. This is firm, Ramu, Robert, partners are there. They took drawings from the firm. They are taking some cash for personal use. So as per business entity concept, partners, owners are outsiders. No? To outsiders we are paying money. We should assume that we are giving loan to them. Then who should pay interest to whom? Partners should pay interest to the firm. In firm's books we are writing entries. No? Think from firm's point of view. To the firm this interest should come. So interest on drawings is an income to the firm. So what is the first account? Interest on drawings account. So income comes under nominal account. No? Nominal account rule, debit all expenses and losses, credit all incomes and gains. So interest on drawings we have to credit. Then which accounts we should debit? Interest on drawings from partners' capitals we have to subtract. Then partners' capitals decrease. No? So capital is a liability, it shows a credit balance. If you want to decrease capitals, while writing the journal entry, we have to debit capitals. So Ramu capital account, Robert capital account, we should debit. First entry, Ramu capital account data. Debit interest on drawings, Ramu 300. No? From Ramu's capital, 300 interest on drawings we should subtract. Next, Robert capital account data 400 to interest on drawings account total 700. Narration being the entry for interest on drawings. Now interest on drawing is also nominal account. No? Nominal accounts are temporary accounts. At the year end we have to close them by transferring to profit and loss appropriation account. Because from the partners, firm is receiving this income. So this income is related to partners. partners related incomes, partner related expenses in P&L appropriation account we should write now. So how we open this interest on drawings account? By crediting. If you want to close this account, you have to debit now. Debit second entry. Interest on drawings account data 700 to profit and loss appropriation account we want to transfer. Therefore, credit profit and loss appropriation account 700. See, profit and loss appropriation account is a nominal account now. So debit side expenses, losses we should show. Credit side incomes and gains. Interest on drawing is income. So income in P&L appropriation account, credit side I want to post. So credit side if I want to post, while writing the journal entry we should credit P&L appropriation account. That is why we have created. Narration being interest on drawings account is closed by transferring the balance to profit and loss appropriation account. Next come to EBIT. Profit transferred to general reserve 9,000. Profit in which account is transferred to general reserve account? Profit in profit and loss appropriation account. Because in trading account profit is gross profit. That we transfer to profit and loss account. In profit and loss account profit is called net profit. That we transfer to profit and loss appropriation account. In profit and loss appropriation account profit, he is asking us to transfer to general reserve. First of all, recollect profit and loss appropriation account. In previous problems I explained, profit and loss appropriation account is a nominal account now. Debit side, credit side. Nominal account rule we follow. Debit all expenses and losses, credit all incomes and gains. And is giving that in profit and loss appropriation account, profit came. Amount is 9,000 rupees. Profit we said it comes. Incomes credit side we wrote. Expenses debit side. When income is more than expenditure, then only profit comes now. So that profit we said we should show where the total is less, that side. Expenditure side total is less. So expenditure side this 9,000 comes. And this 9,000 he is asking us to transfer to general reserve. Means in particulars we have to write to general reserve. Observe the posting. In P&L appropriation account, debit side we wrote to general reserve. If you want to post like this, while writing the journal entry, P&L appropriation account should be debited, general reserve account should be credited. So what is the entry to transfer the profit? Profit and loss appropriation account data 9,000 to general reserve account. In EBIT there is only one entry. Narration is being the profit in profit and loss appropriation account is transferred to general reserve account. Next come to last bit F. Salary to Ramu 10,000 and the commission to Robert 7,000. Ramu's salary 10,000 we should give to Ramu now. Means to Ramu's capital account we should add. Then capital increases. So Ramu's salary to Ramu account is a nominal account. Firm is paying to Ramu. So to the firm this is an expenditure. Expenditure means nominal account. Nominal account rule, debit all expenses and losses, credit all incomes and gains. As per that rule, salary to Ramu account we should debit. His salary is 10,000 rupees. This salary to Ramu's capital account we should add. So after adding this 10,000 to Ramu's capital increases. No? So capital is a liability, it shows a credit balance. If you want to increase, you have to credit capital. No? Therefore, to Ramu capital account 10,000 rupees. Similarly, come to continuation. And the commission to Robert 7,000. Same thing. So firm is paying commission to Robert. To the firm, this commission is an expenditure. nominal account. Nominal account rule, debit all expenses and losses, credit all incomes and gains. To the firm, this commission is an expenditure, means we should debit. Commission to Robert, account debtor. Commission to Robert, 7,000 rupees. Robert commission, we should add to Robert's capital. Then Robert's capital increases, no? Means you have to credit Robert capital, no? To Robert capital, 7,000 rupees credit. So this is the final entry for Ramu's salary and Robert's commission. Narration being the entry for Ramu's salary and Robert's commission. Next entry, second entry under F bit is salary to Ramu, commission to Robert. These two are nominal accounts because to the firm these two are expenses. Nominal accounts are temporary accounts now. We have to close them by transferring the balance to profit and loss appropriation account. Because salary we are paying to partner, commission we are paying to partner. So partners related expenses to P&L appropriation account we have to transfer now. For that second entry we should have. Salary to Ramu, commission to Robert, we have to close by transferring to profit and loss appropriation account. These two accounts are debited, no? By debiting we created them. If you want to close them, you have to credit. And to P&L appropriation account we are transferring, means that account we should debit. So entry is profit and loss appropriation account debtor. 2. Salary to Ramu account, again 2. Commission to Robert account. Ramu's salary 10,000, credit column. Robert's commission 7,000, credit column. Total 17,000, debit column. Narration being Ramu's salary account, Robert's commission account are closed by transferring their balances to profit and loss appropriation account. So with this, first question answer is completed. Journal entries we have completed. Next, what is asking? Give capital accounts of Ramu and Robert. So based on these journal entries, now Ramu and Robert's capital accounts we have to prepare. Capital accounts, debit side, credit side. Debit side, particulars, Ramu, Robert. These are the columns. Credit side also same. See the first entry. Cash account debtor to Ramu capital to Robert capital. So here capital accounts we are preparing. Capital accounts are credited. Therefore credit side we should post. What to write in particulars column? Other side account name. Debit account name. Cash. By cash account. In Ramu's column 50,000 rupees. In Robert column 80,000 rupees. First entry posting completed. Come to second entry. Ramu drawings account debtor, Robert drawings account debtor to cash account. In this entry, capital word is not there. Therefore, this entry we need not to post. B with second entry. Ramu capital account debtor, Robert capital account debtor, to Ramu's drawings, to Robert drawings. Here, capitals are debited, so debit side we should post. To Ramu drawings. In Ramu's column, 5,000 rupees. To Robert drawings. In Robert column, 6,000 rupees. Come to C bit. First entry. Interest on capital account debtor to Ramu's capital to Robert capital. Capitals are credited. Credit side we should post. By interest on capital, Ramu's column 2,500, Robert column 4,000. By interest on capital 2,500, 4,000. Next, C bit second entry. Profit and loss appropriation account to interest on capital account. In this entry, capital word is not there, capital account is not there. So we need not to post this entry here. Next, D bit first entry. Capitals are debited, no? Debit side we should post. In particulars column, what to write? Credit account name. To interest on drawings account. In Ramu's column, 300 rupees. Robert column, 400 rupees. Next, debit second entry. In this entry, Ramu capital, Robert capital are not there. So this entry we need not to post. Next, EBIT, capital is not there, no need to post. FBIT first entry, capitals are credited, so credit side we should post. By salary to Ramu, by commission to Robert. Salary to Ramu, 10,000 rupees in Ramu's column. Commission to Robert, 7,000 rupees in Robert's column. Last entry, here capital account is not there, no need to post this entry. So posting is completed. Next step is balancing. Credit side total is more than debit side total. So first credit side total we should calculate minus debit side total becomes balance character. Robert capital account credit column total is 62,500 minus debit total 5,300 is equal 57,200. For this what to write? To balance character. Next, Robert. Capital account credit column total is 91,000 rupees minus debit total 6,400 is equal 84,600. For that also same balance character. With this, capital accounts are also completed. So this is all about fifth problem from partnership accounts topic. Hope this video is helpful to you. Thank you.